Hey, what's up, everybody? It's Doug Shoemaker here with the Shoemaker Loan Team at Homestead Financial Mortgage. I'm back with your weekly market update. And for my friends that just want to know what time it is, let's go ahead and start with the Cliff Notes version. And for everybody else, if you like to know how to build a clock, make sure you stick around for all the juicy details. All right, let's go ahead and get to it. Home builder confidence just hit its highest level since April, giving us some much needed good news in the housing market. Now, the Fed's Beige book shows the economy is basically treading water. It's not too hot, it's not too cold, but there are some hints of softening, especially in consumer spending and hiring. You guys have been listening. And the 10-year Treasury yield, it actually dipped below 4% late last week, which could give us a really good sign for mortgage rates going forward if that holds. Now, for the weekly rate update, mortgage bonds traded in a tight range last week, finding support near the 25-day moving average and resistance around the 101.31 ceiling. Conventional 30-year fixed rates, they ended the week at 6.22, while VA was at 6%, and FHA loans, they're coming in just a touch below VA at 5.98. Now, these aren't necessarily my rates, they're not necessarily your rates. These are national averages based off a handful of factors like credit scores, debt ratios, your down payment, your loan amount, whether or not you're a first-time home buyer, paying discount points, and a whole lot of stuff. So, if you'd like to see what rate you actually qualify for, make sure you reach out today. It is a whole lot easier than you would think. Now, if the 10-year Treasury stays under 4%, we could see rates drift a little bit lower in the coming weeks. Now, overall, right now, we are at a floating status because we're in kind of a flat or a decreasing rate environment. But if you're in close communication with your loan officer and they're a certified mortgage advisor, they're going to likely be updating you on what the market's doing in a more personal way towards you. Now, if you don't have somebody that's giving you that kind of rate lock or float advice, always feel free to reach out. I'm always glad to help. But if you have a little bit lower risk tolerance than most and you're closing within the next 15 days, I would suggest go ahead and getting that interest rate locked. That way, you've got nothing to think about. You're probably going to have a refinance opportunity coming up in the near future as well. But if you're closing outside of that 15-day window, right now, we would likely advise floating. So, all right, that's your short version. But if you like to know how the clock is built, let's go ahead and dig in. Home builder sentiment, as we said, it's up. It jumped 5 points to 37 in October. And according to the National Association of Home Builders, that's the highest level since April. And while it's still below the 50 mark that signals expansion, it's a solid improvement after months of pretty much flat numbers. Now, all three components of the index improved. Buyer traffic climbed to 25, current sales moved to 38, and future sales expectations actually broke above 50 into that expansion territory. And that's the first time that has happened since January. So, National Association of Home Builders chief economist Robert Dietz, he called this a positive signal for 2026, which lines up with forecasts for more single family home construction next year. So here's the bottom line. While affordability and supply challenges they do still remain, builders are finally starting to feel a little bit more optimistic again, which may mean we could see some inventory increase. So the Fed's latest beige book, they reported that economic activity it's changed a little since the last report. Out of 12 Federal Reserve districts, three of them saw modest growth, five didn't see any change at all, and four of them saw a slight softening. Now that's a bit of a shift from the last report where none of the districts showed any contraction at all. So here are the key takeaways. Consumer spending is easing, especially among lower and middle income households. Prices are still rising, leaving businesses with a tough choice to either eat the cost themselves or pass them along to their customer, which could cause them to lose their customer. Employment is mostly stable, but more companies are trimming staff through layoffs and attrition, citing weaker demand and rising costs tied to automation and AI. And because the government shutdown is delaying key reports like the jobs report and inflation data, the Fed's relying a lot more heavily on the Beige Book ahead of its October 29th meeting. Now, markets are currently expecting another 0.25% rate cut, just like the one that we saw in September, even though inflation remains above the Fed's 2% target. The weakening labor market may push them to ease again. Now, just remember, when the Fed changes its rate, it's adjusting the Fed funds rate, which is the short term rate at which banks lend money to each other. It does not directly set mortgage rates, but it absolutely influences them through the bond market and investor sentiment. All right, everybody, it's time for the family hack of the week. It's National Apple Month, and tomorrow, October 21st, is actually National Apple Day. So let's talk about a really easy, delicious fall treat that is one of my favorites, and that is apple turnovers. I'm going to go ahead and put the recipe down in the description below so that you can taste this fall goodness for yourself. Now, on Thursday, the National Association of Realtors is going to release September's existing home sales report. And on Friday, the Consumer Price Index is set to be released. And it's one of the few reports still moving forward despite the shutdown. It's especially important this time because it helps calculate next year's Social Security cost of living adjustment. Now, for the week's technical picture, mortgage bonds ended last week trading in a narrow range, as we said earlier, with support near the 25-day moving average and resistance right around that 101.31 ceiling. The 10-year Treasury yield closed just below 4%. If that thing holds, it's an encouraging sign for long term rate direction and possibly a green light for better affordability ahead. But if yields pop back up above that 4% mark, we could see lenders pull back a bit. So stay alert if you're in the market to lock probably within the next 15 days. All right, friends, that wraps up this week's market update. If you found this helpful, please like, subscribe, and share it with anybody who's keeping an eye on the market, thinking about buying, or just loves learning about how this stuff works. I'm Doug Shoemaker with the Shoemaker Loan Team. Thanks for watching, and I'll see you next week.